Gaps come in three flavors. There are those that are caused by market-wide events, there are those that are caused by industry-wide events, and there are those caused by internal company events. Now, when we're trading gaps, we really don't care about what gap was caused by who in this system. Because when you trade gaps successfully, you're just using technical analysis. You don't need to dig through the news all day. When you see a gap like this, the gap you're looking at right now, you can tell from this chart, usually on the first couple days, that the gap is going to go in a specific direction. What you're looking at here, let me highlight it. You see this high volume on the day of the gap? That indicates that the gap is probably a breakaway gap. And a breakaway gap is a gap that continues in the direction. In other words, the gap doesn't close, it widens. And that's what we see here in this example. So as the gap goes up, the following days produce a bearish trend, and we see it just slowly move upwards. That's just pure technical analysis, and this works the majority of the time. So really, all you have to do to trade gaps successfully is look at the candlestick chart. Determine what type of gap it is. Don't confuse it with the flavors I just talked about. Just determine what kind of gap it is. For example, breakaway gap. And then once you look at that, if you want to be more certain in the direction, you then look at the resulting candlesticks from the next 2 to 5 days. And you can generally get a very, very high probability of a certain direction. So I'm going to show you another breakaway gap here. This is a breakaway gap that is a bearish trend instead of a bullish trend. What we see, again, is on the day of the gap, this day right here, we see a very high volume. And those high volumes typically produce a breakaway gap or a continuation gap. And those two gaps are gaps that continue away from the gap. So we see the gap here, we see the next day, and then afterwards there's a bearish trend that just continues, goes down. Now, if you subscribe to my newsletters, you'll learn about all these different types of gaps. I'm kind of rushing through this because it's just a YouTube video, but you'll learn about breakaway gaps, you'll learn about continuation gaps, area gaps, amateur gaps, and today I want to introduce you to some of those gaps. The end goal would be for you to learn how to spot one type of gap from another, and then how to maximize your profit by taking advantage of those gaps' resulting trends. So if you can exit and enter at the ideal times, you're going to make a lot of profit just by trading gaps. Alright, so as promised, I'll explain a few of my favorite gap plays. Next one here, I'll call this the immature hack. Now, the idea here is there are many amateurs in the market who buy because they see some sort of price trend. In this chart, what you're looking at is, well, let me explain first. What do I mean by amateurs? I don't want to say that you are an amateur because you're watching this. What I mean by amateur is a trader. He could be a trader who's been trading for a decade. An amateur is simply a trader who trades by common sense and intuition. A pro is a trader who trades by a systematic approach. So what we do, if we are pros, is we also recognize that amateurs are trading in the same market we are, and we take advantage of their reliance on common sense and intuition. So what we do is we identify the gaps that are made by amateurs, and we use the right strategy after we see that gap so that we make money off of their plays. I'm going to explain this to you. So here what we see a gap without a high volume. Notice that? The volume is pretty standard. It's within the normal volume range. We see a high volume here, but that's not a gap, so ignore that for now. When this gap occurs, a pro will, depending on his trading strategy, will look at certain aspects of the gap. So what I look at is the volume, and I see the volume is, well, it's pretty normal. So this gap is probably not significant. It's probably going to be an area gap. It's probably going to close. In other words, later we're going to see this gap filled. So even though this is moving upward, on this day I would see this gap, I'd see this volume, and I would think with a high probability the trend is going to reverse. It's going to become bearish. But if I were watching and, oh, I got to go back. All right, if I were watching and I saw the next day there's another gap, I would think that's strange. There's another gap, yet the volume is still in the standard trading region. At that time, I'd recognize that was probably caused by amateurs looking at the first gap, thinking the stock is going to go up, and then buying, which made the price go up as well. Now at that time, I would likely put a put option, or you could just short the stock at this point. Once you do that, you're just waiting, because you know from what you saw earlier that this volume is standard, therefore the gap is likely to close. And if you're going to bet that the trend is going to reverse by buying a put or by shorting the stock, you're going to make money by closing that gap. So if we short the stock at 6.8 and we see that the gap will close probably at 6.2, well, that's 6 cents or 60 cents per stock that you have in terms of profit. So, well, what are amateurs thinking right here? They're likely thinking, we see the gap, they're likely thinking, if it's going up so quickly, I'd better get in on it now. And they get in on it, but usually it's a little too late. And it drives the price of the stock to an overbought area, which means it's going to fall pretty quickly and pretty soon and pretty rapidly. What the amateurs don't know is that this stock was already going up at this time at a market fair speed. And then the amateurs get on some sort of crazy buying rush. The stock becomes overvalued. Then what happens? The pros will sell the stock that they bought here. So they take advantage of this amateur gap. To play this, let's look at this arrow quickly. See that indecision? When you see a very, very small candlestick body, it usually implies that people are at odds with whether this stock is overvalued or undervalued. So a lot of people are just like saying, okay, I think I should sell it now. Other people are saying, I think I should buy it now. There's that indecision right there. And it pretty much sticks at a price. Now, when you see indecision on this kind of play, where there's not a lot of volume differences between the trading days, you can guess that it's going to reverse directions, especially here. So that's a pretty good indicator that this truly is an area gap and will close. So let's look at how you play this amateur hack. What you basically look for is two gaps in a row, 1, 2, with low volume. When you see that, you can assume that the first gap was caused by pros, the second gap was caused by amateurs. What you do is you wait for the amateur buying to stop. You see how it slows down here? There's resistance. When you see a candlestick shadow that goes really high up, you can, but not on the other side. It goes really high up. What you're seeing here is resistance. So the market has basically said this stock is worth no more than about $7. And at that time, there's no reason to buy the stock because it's not going to surpass 7 unless there's some sort of news event or breakout of some sort. So at that time, you would buy a put option or you would short the stock. Then the price will fall back to the normal value. And once that happens, you sell your put or you buy back the stock. So if it were me, we actually see that the bearish trend continues a long way down. But if it were me, what I would do is I'd buy the stock, or I'd buy the put. I'd wait for the stock to drop down to this normal level. So that would be on this day. So I'd probably sell it right here. And if you're playing with a put, you can make a lot more money than if you were shorting the stock. But if you're shorting the stock and you use this strategy, you could have made about a dollar per stock shorted. So the strategy is simply look for two gaps with normal volume, wait for the stock to begin to close, and if you're playing with shorting stock, you can just set a limit order to buy back the stock once it hits that point. So the pros will sell off, the amateurs usually will see that and then do the same. So pro, amateur, and then again pro, perhaps amateur. We don't know. It doesn't matter. The point is, we know at this point that the stock is going to fall and most likely close that gap, and that's where we make our profit. Okay. The next strategy here is a breakaway strategy. We looked at a couple breakaway charts at the very beginning. Here is another. What we see is rapid selling with high volume. When you see that, that's a downward breakaway. Now a breakaway refers to the stock being at some sort of like stable level. You see here, between 17 and 19 is the stock's trading region for about almost a month. And then suddenly it drops. Because of the high volume, we know that that's probably going to be a breakaway, and that's a blessing to us. A breakaway typically happens when there's some sort of news event, but we don't really care and we're not going to actually look that up because we're just looking at the charts, the technicals here. What we want to do is we want to ride this wave downward. We aren't always sure where it's going to stop, but at least we know that there's a trend in place. So this is one of those situations where you can short and hold, and if the breakaway gap goes upward, you can buy and hold. But we're just making money on the prediction of the trend instead of the prediction of the price that it will end up at. Now, what we see is we always want to check to make sure that there's no amateur gap, because sometimes a breakaway gap will go too far in the extreme and then it'll go back the other way, and we don't want to see that bounce back. We want to make sure that it kind of evens out or it just continues falling at a pretty normal pace. And what we see here is it does pretty much stabilize at around 13 or 14, and once the volume goes back down to normal, we see a new trend in place, and that trend is a bearish trend. So this is a very useful type of gap trade that can make you a high amount of profit, and it's often misunderstood because people see this drop and most amateurs will think, damn, why didn't I buy this stock when it was at 17? But that's not how you trade gaps. You trade gaps by looking at what happens after the gap. So even if we get in on this trend a little later than we would have wished, like obviously if we bought it at 19 that would be awesome, but we wouldn't have known that there would be a gap. So we look at what happens after the gap, and if it seems like it's going to fall, then we get on that trend at that time. Yeah, okay, moving from 14 to 11 is not as good as moving from 18 to 11, but still that's a very, very predictable trend that we can make quite a bit of money on based on how much we invest in it. So that is the breakaway gap. Alright, and this is the area gap. An area gap usually doesn't have high volume as we see here, but I'm going to use this as an example anyway. So sometimes it will have high volume, but usually it won't. Usually it will be like that amateur hack that I introduced a while back. Now, a area gap is pretty simple. It's a gap that closes. What you'll see is that without previous warning, a gap spikes. And that spike could be the result of news, or well, we don't know and we don't care, but it's usually related to news. And well, like I said, we don't care. So I'm not going to talk about that. I could talk about that another day. So let's just focus on the technicals for today. Usually gaps will close if they are area gaps. Here we see high volume. We're not really sure if it's an area gap. So as a good gap trader, you will actually just wait a couple days. you'll see on the first day, here's the candlestick. It's that candlestick we saw earlier with a very tall shadow on the top, but almost no shadow on the bottom. That implies resistance. The market says that the stock is probably not worth $7.5, and the stock is very, very unlikely to continue upward. At that time, because of the resistance, we can guess that this gap will actually close. And if we buy the stock at if we short the stock at 7 and it goes down and closes the gap at 6, we've made $1 per share. That's exactly what we're going to do. So we see the resistance, and we're pretty confident that the trend will reverse, effectively closing the gap. Usually this takes several days. So you do have plenty of time to get in on the trade. The benefit of this is that when we look at the gap, we can be pretty certain of how much profit we can take away. The bigger gaps obviously will give us more money. If this gap was only up to 6.4, it might not be worth playing. But this is a very useful strategy that gives you pretty consistent rewards. Often the gap closes 100%, which means that the stock will reach the price it was at before the gap. And well, sometimes it doesn't. Sometimes it goes maybe 70%. If you're a risk taker, I say you set a limit at the original price. And if you're not, if you're more of a conservative trader, you might want to set a limit at like 70% of closing. So you could just calculate how large is the gap, multiply it by 0.7, then subtract from the price you're going to short it at, and that's your limit, your price limit. Now, here's an example of that. It's probably a bit over 70%. It's nearly 90%, I would say. And at that time, you just exit and you take your profit. That's it. So I hope you enjoyed the video. If you have any questions, just contact me at damonverio.com. Also, you can visit damonverio.com for a free guide on gap trading.